Peterson Institute for International Economics. I'm Adam Posen, the Institute's president, and we're very glad today to be able to welcome Norges Governor Wolden Bache, give my pronunciation, on monetary policy challenges in a small open economy, the case of Norway. Governor Wolden Bache has been a leader in free thinking, much as you would expect from a Norwegian internationally recognized civil servant, independent of mind, fact-based, pragmatic. And I've had the privilege to get to know her a bit and to hear her speak in various venues. And we at the Peterson Institute have had the pleasure of working with the Norges Bank and Norges Bank Investment Management, as well as the Norwegian Embassy here in Washington and other Norwegian government officials. This would be worth hearing on its own merits from the governor. But again, I would like to emphasize this is part of our commitment this macro week and this fall into the new year at the Peterson Institute to try to bring to Washington and to the world more of the perspective of the third nations, the small open economies that are neither China nor the US, and to some degree not the EU. I don't mean Norway is some degree the EU, I mean for our programming. The whole notion being that whatever the results of the election here in the US, both China and the US are going to continue some of their conflict at a minimum. This will have spillovers and volatility effects on the rest of the world, and we all have to think together about how the rest of the world can maintain, promote, and manage a relatively open, relatively integrated world economy while China and the US behave that way. And so we've asked this week a number of central bankers and finance officials from like-minded, open-minded, in both senses, economies to come join us at the Peterson Institute. And today our highlight is to have Governor Wolden Bache. Ida Wolden Bache was appointed the governor of the Norges Bank from April of 2022, and her term lasts until 2028. She is chair of the executive board and the Monetary Policy and Financial Stability Committee. Her work experience includes posts as deputy governor, executive director of Norges Bank Monetary Policy, and of Norges Bank Financial Stability. She has also been a macroeconomist at Handelsbanken and capital markets. She has even served abroad as a member of the Systemic Risk Council in Denmark in the period between 2017 and 2022. She has a doctorate in economics from the University of Oslo and an MSc in economics from the London School of Economics. And again, let me say she is a voice widely respected and included in the monetary policy debates around the world among central bankers, and we're very glad to have her with us today at the Institute. Governor, please.
Good afternoon, everyone, and thank you so much for the introduction, and thank you to the Peterson Institute for the invitation. It's a great pleasure to be here. Now, the tightening of monetary policy by central banks over the past few years has been unprecedented in several respects. And by some measures, this has been the most globally synchronized of all tightening episodes in the past half century. In Norway, as in many other countries, global supply chain disruptions contributed to a rise in prices for a broad range of goods during the pandemic. And when pandemic restrictions were lifted, economic activity quickly rebounded, with a high level of household saving giving an additional impetus to demand. Then, when Russia invaded Ukraine in February 2022, energy and commodity prices soared. Now, since Norway is a major exporter of oil and gas, those price increases constituted a positive terms of trade shock for the Norwegian economy. And they generated large inflows into the Norwegian Sovereign Wealth Fund, the government pension fund global. But at the same time, The increases in energy prices contributed to pushing up business costs and spilled over into consumer prices. Norway started a gradual normalization of interest rates in September 2021. And our key policy rate now stands at 4.5%. The policy rate forecast in our latest monetary policy report in September, shown here, implies that the policy rate will remain at 4.5% to the end of this year, before being gradually reduced from the first quarter 2025. Now, the trade-offs we face when setting interest rates depend on the shocks that occur, but they also depend on the relative strength of the different transmission channels of monetary policy. And the transmission channels can vary both across countries and over time, depending, among other things, on institutional features of labor and housing markets, as well as the balance sheets of households. In my remarks today, we'll focus on one particular aspect of the monetary policy transmission mechanism in Norway, namely the strong direct effect of monetary policy on household spending operating through net interest expenses. And as I will return to, the strong cash flow channel, combined with an unexpectedly large currency depreciation, has created some particular trade-offs for monetary policy in Norway over the past few years. Now, the cash flow channel from monetary policy to household spending is likely to be stronger when households are more indebted and when interest rates on outstanding debt are tightly linked to short-term rates. And along both of these dimensions, there is a lot of variation across countries. Norway has over many years benefited from revenues from our petroleum sector, and with more than $1.7 trillion invested abroad through the Sovereign Wealth Fund, the Norwegian government is a large net lender. But Norwegian households are among the most indebted in the world, with an average debt-to-income ratio of close to 250%. Since the interest rate on 95% of home loans moves in tandem with short-term money market rates, there is a fast and strong pass-through of policy rate hikes to household disposable income. By comparison, in the US, where fixed-rate mortgages account for more than 90% of home loans, most of them with an initial 30-year fixation period, and the average household is less indebted than in Norway, the pass-through of higher policy rates to borrowing costs can be expected to be much smaller in the short run. And in fact, while the policy rate has increased more in the US than in Norway during the recent tightening cycle, interest payments as a fraction of income has increased by much more in Norway. Now, to gain more insight into this cash flow channel, we have recently assembled a new and unique data set that combines rich information on household balance sheets and income from tax returns with directly measured consumption expenditures from individual electronic transactions for all residents in Norway. And using this data set, my colleagues have estimated how much the responsiveness of consumption to interest rates varies with household indebtedness. In this chart, you can see the change in consumption following a 1 percentage point unexpected increase in the policy rate, and how that varies with a household's gross debt-to-income ratio. And as we can see, the consumption response to a policy tightening increases with indebtedness. And these effects set in a couple of months after the interest rate hike and increase over the course of the first year. If we compare a household with a debt-to-income ratio of 3 to a household with no debt, the indebted household will cut spending by around 1.5 percentage points more after 1 year. And we can use these results to understand how the monetary policy transmission mechanism has changed over time. Now, households' debt-to-income ratios have increased markedly in many countries over the past quarter century. In Norway, household debt increased from around 120% of disposable income in 1995 to almost 250% in 2021. And a back-of-the-envelope calculation based on our microdata estimates suggests that due to this increased indebtedness alone, aggregate consumption will fall by around 50 basis points more in reaction to a 1 percentage point contractionary monetary policy shock now than in the 1990s. And that amounts to as much as a 2/3 increase in the interest rate effect on household spending. Now let me explain how a strong cash flow channel can give rise to a particular monetary policy trade-off in a small open economy that is hit by a shock that increases inflation, a cost-push shock, or an unexpected exchange rate shock. Now, according to textbook theory, the central bank should respond to either shock by increasing the interest rate to bring inflation gradually back to target. A higher interest rate dampens aggregate demand directly, but also contributes to appreciating the currency. If the aggregate demand channel is strong compared to the exchange rate channel, for instance, because cash flow effects on consumption are important, a larger reduction in output is needed to achieve a given disinflation. And that is because more of the disinflation will come through lower output and employment and less through lower imported inflation. In other words, when the aggregate demand channel is strong, the so-called sacrifice ratio of stabilizing inflation is high. Lowering inflation sufficiently comes at a cost of a larger increase in unemployment. In small open economies where the effects of monetary policy on aggregate demand are relatively weaker, the central bank gets more help from the exchange rate in bringing inflation down. And inflation can be stabilized at lower employment costs. And against this backdrop, let me share some perspectives on the krona exchange rate. Over the past 3 years, the Norwegian krona has depreciated by 10% against an import-weighted basket of currencies. Against the dollar, the value of the krona is 23% lower than it was 3 years ago. Now, the newspaper The Economist has referred to the weakening of the krona since the pandemic as a mystery. And while it is challenging to explain all movements in exchange rates, we do believe we know something about the factors that have affected the value of the krona over time. First, over the longer term, real structural factors matter. For example, research on Norwegian data suggests that the build-up of the Norwegian petroleum sector drove a stronger real exchange rate from the beginning of the 1970s until the beginning of the 2000s. And this research also suggests that the subsequent decline in the importance of the petroleum sector for the Norwegian economy has since pulled in the direction of an exchange rate depreciation. Second, in recent years, the pandemic, war, and high inflation has led to heightened geopolitical and economic uncertainty, and market volatility has increased. And this has led to a flight by investors away from less liquid and more volatile currencies. And adding to this, the rebalancing of Norwegian asset managers' hedging positions in response to declines in international asset prices may also, in periods, have contributed to the weakening of the krona. That is not to say that monetary policy does not matter. The exchange rate does react to our monetary policy decisions. And we have seen over time that a tightening of monetary policy that is unexpected by the market normally does lead to an immediate krona appreciation. And what other central banks do also matters. Through the spring of 2023, the interest rate differential against Norway's main trading partners fell, and the differential turned gradually negative. The decline in the interest rate differential did coincide with the krona depreciation over that period. Now, the depreciation of our currency over the past few years has slowed the disinflation process in Norway. While CPI inflation rose less in Norway than among our main trading partners throughout 2022, inflation has since fallen at a somewhat slower pace in Norway. A weaker currency directly pushes up imported inflation, and it also raises inflation for domestically produced goods and services through the effect of the exchange rate on the prices of imported intermediate goods and on wage growth. In Norway, we have a system of coordinated wage determination in which the profitability of the manufacturing sector, which has a high export share, has a strong bearing on wage settlements in the rest of the economy. In general, we believe that this system of coordinated wage determination contributes to counteracting wage price spirals. However, a weaker krona exchange rate normally causes export sector profitability to rise. In turn, could lead to higher wage growth and result in higher inflation. So let me conclude. The cash flow effect from interest rates to household disposable incomes is strong in Norway relative to many other countries. Combined with the depreciation of the currency, this has created some particular trade-offs in Norway over the past years. And these trade-offs have had a bearing on interest rate setting and the speed at which we aim to bring inflation back to target. At the time of our latest monetary policy meeting in September, our assessment was that the policy rate needed to be kept at today's level for a period ahead. But at the same time, we are approaching the time to lower the interest rate. And with the September policy rate path I showed you earlier, inflation is projected to move down further and approach 2% towards the end of 2027. Unemployment will likely edge up to about the level prevailing before the pandemic. Now, looking further ahead, the job of ensuring price stability may become more demanding. The consequences of climate change are becoming increasingly visible, and a global transition to a low-carbon economy is imperative. Geopolitical tensions and the desire to safeguard national supply lines are affecting trade and cross-border cooperation. At the same time, technological innovations and artificial intelligence may lead to upheavals in labor markets. And these developments will pose challenges to all aspects of economic policy in small open economies, including to monetary policy. Large changes in relative prices may be necessary. Now, with a flexible inflation targeting regime, we can look through temporary changes in inflation. But still, the most important contribution monetary policy can give to support the necessary structural change and high employment is to ensure low and stable inflation. I'll stop there. Thank you.
Thank you very much, Governor, for your remarks and for taking us through so clearly and concisely the kinds of assessments you and your colleagues are making as a central bank. As we said, we're trying to learn about Norway, but also, as you did with the cross-sectional graphs, think about broader lessons in monetary policy. So if I could, before turning to our audience, I'd like to explore a couple of those. First off, for those of us who are not as knowledgeable about Norway, seeing a country have such a high debt-to-income ratio for the household sector is quite striking. Does that create any financial stability worries you have to take into account? Is that an artifact of the housing market or something else? Do you see that as being a ongoing feature of the Norwegian economic landscape? I mean, just sort of how do you think about it when you see your country, your economy looking sort of like an outlier?
It's true that household debt ratios in Norway are among the highest in the world, similar to some other smaller.
Yes.
Now, of course, that should be seen against the overall balance sheet of the households, which indicate that the average Norwegian household is sound on the basis of having high residential property values and also other liquid savings on the other side of their balance sheets. So overall, the picture is more nuanced, of course. But it is something that we have highlighted over the years as a key vulnerability of the Norwegian economy as regards financial stability. And while we do not worry as such that we will see large defaults on mortgage debt, we have worried that in the event of an abrupt monetary policy tightening or a global crisis, that you could see a sharp contraction in household consumption, which would have spillover effects to the real economy, affecting the banks and thereby the financial system. So this has been a key concern and a motivation for implementing a number of macroprudential tools over the past 10 or 15 years, including countercyclical capital buffers for banks and other capital requirements, and also borrower-based measures. So this is something that we are monitoring closely. But going through the past few years, households have in fact managed the situation fairly well, and consumption has held up better than you might have expected.
Another aspect you spoke about in terms of monetary transmission and differences across countries was how Norway and perhaps other small open economies get back on the exchange rate what they may not get on the rate hike side. I must admit, I didn't fully follow that. Could you expand a bit on what you had in mind when you were saying that, and is that a Norway-specific thing or something you think is more generally applicable?
I think it's a general feature of open economies, or small open economies in particular, where you have a significant pass-through of exchange rate changes to the domestic economy, directly through prices, but also through activity. That you have another important channel for monetary policy. And the strength of that channel relative to the aggregate demand channel matters for the trade-offs you face. It can make monetary policy easier in some circumstances, but when you experience a cost push shock like what we've experienced over the past few years, it actually makes that trade-off worse, in the sense that if you have a stronger cash flow channel relative to the exchange rate channel, you don't get as much help from the exchange rate channel, which would have led to a less costly disinflation than when you have the relatively strong cash flow channel. So that could vary across countries depending on the strength of that cash flow channel.
Okay, I think I got it. I'm not trying to be difficult, but I'm genuinely interested. The last step is the sacrifice ratio being less. You mean in terms of if you just measure the response of the real economy to the interest rate you're defining, or to the inflation rate? Because I'm not clear why a move in the exchange rate would have no effect on the real economy.
Oh, it does. So this is just about, so the exchange rate affects both activity and the real economy and inflation. But the general direct effect on inflation is stronger than the effect operating through the real economy.
Got it.
In that sense, the relative channels matter. That could be different in other countries.
Of course. Thank you for clarifying. Continuing in this vein, as I said, we're very glad to have you with us today. We've, I believe, had your predecessor. We've had previous chairs of the Swiss National Bank come speak. And obviously there are differences between your two countries, but both of you are economies that are seen as well capitalized, well managed, havens for capital flows during times of difficulty. So it was very interesting to me to see that in recent years the krona has actually depreciated, that there wasn't this sort of flight to the krona there's been in the past. I'm not going to ask you to comment on particular exchange rate swings, but just how do you and the Monetary Policy Committee think about the exchange rate? Have there been situations where, as the Swiss have done, they felt the need to lean against exchange rate inflows because it was too hard an adjustment for the export sector or was counteracting monetary policy goals? Do you expect that problem to recur? Just sort of how do you view the exchange rate management aspects of the monetary policy setting?
First, let me say that we have seen on previous occasions of heightened global uncertainty that the krona has not behaved as a safe haven currency also previously. So in that sense, that was, I guess, not as unexpected, but it's clear that the krona depreciation has been stronger than we had anticipated over the past few years. And it's hard to explain all those movements, although I can point to some factors that have likely contributed. Now, we have a very clear floating exchange rate regime in Norway, so we do not have an objective for the exchange rate. Our objective is 2% consumer price inflation, but of course the exchange rate matters for inflation, and it matters for activity and employment. So we pay close attention to movements in the exchange rates, and we respond using the interest rate to not to the exchange rate itself, but to the anticipated effect that has on inflation. So we consider that similarly to all other factors affecting inflation.
We also had earlier this week another counterpart of yours, Adrian Orr, the governor of the Reserve Bank of New Zealand, who in slightly different terms takes a similar approach. They take a similar approach on the exchange rate. Given that you also have a notable sovereign wealth fund and are a surplus running economy, does that make your life easier in navigating these things, or is that just on a completely separate track? I mean, I understand from a governance point of view, it may be on a completely separate track, but in terms of your economic thinking and forecasting, is it a separate issue?
I would say largely yes, in the sense that the pension fund is governed under a very strict mandate given to us by the Ministry of Finance. So there is no interaction as such between the management of the fund and our monetary policy. That's not to say that the existence of the fund and the large wealth that the government has, which is owned by the people, could affect macroeconomic outcomes. That could affect the willingness of consumers to smooth consumption, implement prices as they. But this implies that there is fiscal room to maneuver and social safety net that could influence consumer behavior. But more those indirect effects. These funds are invested purely in foreign assets, and they are transferred into the Norwegian economy according to agreed upon fiscal policy rules. So through the effects of fiscal policy, obviously, the value of the fund.
Forgive me if my questions seem too elementary, but I'm trying to draw out for our audience some amount of feeling for the differences, views that you overcome and you deal with. Let me, if I could, Governor, bring it back to a more broad monetary policy question, which you made reference to in your remarks. Arguably, we're already in, if not entering, a situation where there's going to be probably greater volatility internationally, possibly more frequent supply shocks, possibly mostly in one direction. How do you and the Monetary Policy Committee, how do you and the Norges Bank think about this? I mean, is the current inflation targeting regime sort of fit for purpose, and each time you'll decide, is this a one-time shock, is this not a one-time shock? Or if the shocks are frequent and not evenly distributed, positive and negative, does that change how you think about this?
But see, overall, I think we believe that our flexible inflation targeting regime is fit for purpose also going forward. But stabilizing inflation could be more demanding, and you're pointing to exactly that, identifying whether this is a temporary shock, to what extent it will spill over to the rest of the economy and to other prices. That will be a key challenge. And you would not want to go against those necessary relative price changes that are important for the structural transformation to happen. So in that sense, you want to be flexible and allow those relative price changes to occur. But at the same time, I think as the past few years has reminded us that maintaining well-anchored inflation expectations will be as important as ever. So you really need to stick to the inflation mandate and trying to be nimble and flexible. So that will be challenging, but I think our regime and the specific mandate we have in Norway is well suited for that. It will require some good economic analysis to identify those shocks in real time.
A specific set of shocks, or perhaps they should be better thought of as trends, are having to do with the green transition. And a number of central banks are discussing, theorists, academics, and even think tank people are discussing, if we live in a world of ongoing rises in carbon prices, or perhaps technological shocks and price shocks in fossil fuels, should central banks be treating that differently, right? Is there a carve-out or a redefinition of the inflation target series or should investments in green be thought of differently by the central bank? Obviously, the central bank's not doing the investing, your fiscal authorities. This is a very live discussion. What is your current thinking on this set of issues?
Yes, it's a live discussion, and we're following that discussion, obviously. Just to say where we're starting from is that we have a clear mandate on inflation and on employment. We do strongly believe that there are other authorities, political authorities, that have the most effective tools and responsibility for managing the climate transition. We do not believe that we have tools that are very efficient or effective in combating climate change, particularly the policy rate. And I can add to that we haven't had any asset purchase programs the past 10 years either. So we have a fairly simple FX reserve portfolio. So that aspect is less relevant than in some other countries as well. I don't think we think of these, I think distinguishing between trend rises and persistent temporary increases in different prices, I mean, that's a challenge for monetary policy on carbon taxes, but also on other prices and other issues, and that will be a challenge because you want to deal with that in the appropriate way. But I don't think our starting point is that this is something that we should treat entirely different. But we do spend a lot of time trying to understand how climate change affects the economy, how that transition, in particular energy transition, will affect the Norwegian economy. Try to incorporate that in our models and in our analysis to conduct monetary policy in the best possible way.
Another issue very much in discussion this week, but in central banks and economic policy networks in general, is essentially how much has R-star risen in the US versus elsewhere, how persistent and important are potential divergences in the R-star level. You mentioned about technology both as a shock and also some potential disruption to labor markets. What's your thinking on, not precisely because we can't measure it, but sort of what's the direction and speed of travel for an R-star for Norway? How much can you expect to maintain divergences from either the US or the Euro area? I mean, it may be a reality, it may not, but how do you think about that?
Well, as you're alluding to, obviously the neutral rate is an elusive concept, and it's inherently uncertain and hard to measure, and there are a variety of different definitions as well. But as a monetary policy committee, we do believe we need to have some kind of idea where we think the neutral rate is as the guide for policy, although that's not sort of a fixed number that we aim for precisely over the forecast horizon. And adding to the uncertainty and what makes it even more complicated to estimate for small open economies, of course, what you're saying, how much can you diverge from other neutral? We have made some estimates. We actually update and publish estimates of the neutral rate on a regular basis. We did a new assessment earlier this year, revised the estimates slightly upwards, but we now have the neutral rate between 0 and 1. I guess it has been previously slightly lower than the US and slightly higher than Europe. But of course, this is something we will hopefully learn about now, where it will settle, if it will settle, the concept of suit.
Well, let me turn it to our in-person audience. Of course, this video and the governor's remarks are going out globally online. Please identify yourself when asking a question and making a question.
Jacob Kierkegaard from the Peterson Institute. Two quick questions. You mentioned in your remarks that the Norwegian kroner has depreciated. There's one particular exchange rate relationship that I would like to ask you about that I really don't understand, which is the remarkable stability between the Swedish and Norwegian kroner, which basically has fluctuated around the sort of exchange rate of 1, plus minus, say, 3 or 4% for pretty much the last decade. Why is that? Is it a policy decision, explicit, implicit, or is it just a coincidence? And then secondly, if you will allow me to ask you a slightly political question. You mentioned that Norway has benefited from a positive terms of trade shock since the outbreak of the war in Ukraine. Now, there is a slightly less generous way of describing what happens when a country makes a lot of extra revenue when a war breaks out. You are essentially a war profiteering nation. And the money is not small, right? Back of the envelope estimates would suggest that Norway has earned somewhere around $200 billion in extra gas revenue based on what the forward price and expected export quantities in the summer of 2021 would have implied. So I don't think it's necessarily a bad thing that you charge Germans more for their gas than Putin did. I think they in some ways deserve it. But it is nonetheless quite striking, I find, that given the fact that Norway is the richest country in Europe.
This has to be a question.
Yes, it's coming. Norway is the richest country in Europe. You earned $200 billion extra from the war, why are you giving so much less to Ukraine than your Nordic and neighboring Northern European countries? Thank you.
Finally, there was a question, but you can decide whether or not to answer.
I think I will leave the political question aside, if that is okay. But the first question was also a question which I do not have a precise answer to, of course. But it's true that if you look at, and that's true over the past few years as well, that we have seen a pronounced depreciation against the US dollar, some against the euro, but against the Swedish krona, it's been a lot more stable. And we take that to indicate that you cannot look solely on domestic factors to explain. And there's been a lot of hypotheses and discussions in Norway about the reasons for that depreciation. And we've used this fact to highlight that they are not necessarily Norway-specific factors that have caused the depreciation, that larger global factors have played an important role, and we still think it does. But there's no coordination of monetary policy or sort of element of that, if that is what you had in mind. But I think exchange rates are notoriously difficult to explain and even more difficult to predict, and but we have to take account of the effects that the exchange rate has on the economy when we set monetary policy.
Hi, I'm Joe Gagnon, Senior Fellow here at Peterson. My question, I was struck, like Adam was, by the very high debt, household debt in Norway. And one thing that occurred to me is there any evidence there for the idea of Ricardo neutrality, where what Norway is really unique on is having a large positive government asset position instead of almost every other advanced economy, a large negative asset position. Is there any sense in which Norwegian corporates and households borrow more on net because they see lower future taxes and higher transfers coming from all the government savings? You mentioned, well, they actually have a lot of assets, so maybe that's not true, but I'm just curious, do you have a sense that households and corporates in Norway offset or look forward and offset some of the savings the government does?
I think that's a reasonable question and a reasonable hypothesis. So I don't have any evidence to sort of concrete evidence to support or reject that hypothesis. But as I was indicating earlier, the fact that we do have, and rather than talking, I guess, about it directly as a Ricardian effect, the fact that we have this social safety net supported by the sovereign wealth fund and ample fiscal space that can be used in a crisis, that could influence consumer behavior and make them less, and that could have contributed to the willingness of consumers to smooth consumption also over the recent years. So, but I don't have any specific evidence to point to. But that's something that we have been mentioning. I think that the high household debt in Norway is related to the fact that we have a very high home ownership rate. And that has been sort of a feature of our economy and embedded in our economy. And that varies across countries, and that, of course, has contributed to the level of household.
I think we're going to have to end it there, except to say, Joe, maybe there's a paper or policy brief to be written, or maybe you could co-author at the Norges Bank Research to do it with. With that, let me thank Governor Ida Boken. Ida. Let me thank Ida for joining us today, speaking fluidly, clearly, and I think informatively for us as we all try to think about how economies and central banks navigate the volatile world we live in. Thank you very much for